OptionChampion.com.
Today is Saturday, September 10th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this Saturday, coming off of a very green week for the cash market indices. The Dow gained 833 points on the week. The S&P 500 gained 143. The Nasdaq Composite gained 481. The Russell gained 73. And volatility came in by $3.20. Crude oil ended the week lower by $1.15. Gold gained $5. Silver gained 88 cents. And natural gas finished the week lower by 86 cents. All right, today we're going to look at breaking apart a ratio put spread and positioning the legs at different strikes. If you recall from the previous episode, a ratio spread consists of unequal parts where an investor buys an option at one strike and then sells a greater number of options at another strike. In this episode, we're going to look at how we can break apart a ratio put spread and still receive a good credit. Let's assume XYZ is priced at $38 per share and we want to put on a 1/3 ratio put spread with 41 days until expiration. If we wanted to put on a traditional 1/3 ratio spread, we could just buy one put at the 34 strike for 85 cents and sell 3 puts at the 33 strike at 65 cents each for a net credit of $1.10 on the trade. Now, there's nothing wrong with this setup. This would be a perfectly good trade. The short side of the spread at the 33 strike, which is the side that would carry the most risk, is $5 out of the money, and the $1.10 would be a good amount of credit received on the trade. But a ratio put spread also has an embedded long put vertical spread that's profitable if the underlying stock price falls below the short leg of the spread. In this example of a 1/3 ratio put spread, the long vertical spread is the long put at the 34 strike and one of the short puts at the 33 strike. If the underlying stock price were to fall below the 33 strike, that embedded vertical spread could be closed for a profit, leaving the 2 remaining short puts open. But there's one problem. With the stock priced at $38, the 33 strike is $5 away. That means the stock would have to fall by $5 or more for the embedded vertical spread to become profitable. The chances of that happening are probably slim, so how can we break apart this 1/3 ratio spread in a way that we can increase our chances of profiting from its embedded vertical spread and still receive a good overall net credit on the trade? Well, let's take that embedded vertical spread and move it to the at the money strike, the strike that is at or near the price of the stock. We can buy one put at the 38 strike for $2.21 and sell one put at the 37 strike at $1.78 and then sell 2 more puts at the 34 strike at 85 cents each, all for a net credit of $1.27 on the trade. With this setup, we would pick up an additional 17 cents in credit compared to the $1.10 in the first example. But could we break it apart even more and still receive a good credit? Let's break up the 2 lots at the 34 strike and instead sell one put at the 34 strike at 85 cents and sell another put at the 33 strike at 65 cents. This setup would give us an overall net credit of $1.07, which is pretty close to the $1.10 in the first example. By breaking apart the 1/3 ratio spread like this, we now have a long vertical spread that is much closer to the stock price and will profit if the stock falls by $1 or more, and we have our short puts that are farther away from the stock price and as a result reducing our risk of assignment, and we still receive a good overall net credit of $1.07 on the trade. In addition to all of that, this setup also gives us a couple of buffers. The long vertical spread would have a maximum profit of $57. So if the stock price were to fall below the 37 strike of the vertical spread, we could close it for a $57 profit and leave the two remaining short puts open. If the stock price continues to decline and touches or breaches the 34 strike, we could roll that option down to the 33 strike and increase our size there, or roll it out to a later expiration cycle. And finally, if the stock price remains above all of our strikes through expiration, we could let all of the options expire worthless and keep the entire $1.07 credit as profit. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.